As you would be aware by now, traders look at the market in two different ways: fundamental analysis and technical analysis. This is a basic lesson for people who are brand new to technical analysis. This video assumes no prior knowledge at all and just requires enthusiasm to learn. Technical analysis is all about the saying that history repeats itself. Technical analysis is the art of using past patterns to predict future ones. Technical traders are those who focus on historical price action to try and determine what is going to happen with future price actions. As a general rule, technical traders tend to be more short-term in nature. We're now going to spend a few minutes talking about different types of charts. Charts are a graphical representation of prices over a period of time and are the best way to see all the moves the price has made at a glance. Charts are the working tools for the technical analysis, and by consulting the chart, traders try to determine which direction markets are going to move. Based on representation, the three most common types of charts used by technical traders are the line chart, the bar chart, and the candlestick chart. The charts can also be differentiated based on periodicity that range from intraday, i.e. 1 minute, 5 minutes, 15 minutes, 30 minutes, hourly, or 4 hourly, to weekly or monthly charts. The line chart is the simplest form of a chart which represents only the closing prices over the set period of time frame. The only problem with the line chart is that you don't get to see the intraday volatility, which is more often used for a short-term trader. The bar chart provides more information than the line chart. The vertical line represents the high and low price for the time interval, and the horizontal lines on the right and the left provides information about the open and close price for that time interval. The advantage of using a bar chart over a line chart is that it shows the high, low, open and close prices for the selected period. The last type of chart is the candlestick chart. This is the most famous type of chart and frequently used by technical traders. Unlike a bar chart, the candlestick chart has a body that represents the period's open and close prices. There are many useful tools and indicators available to understand historical movement and patterns. Learning how these indicators work helps to increase the accuracy in predicting future price action. In this part of the video, we will have a brief outlook of the types of technical indicators. Before we do that, first let's understand what is a technical indicator. Technical indicators provide a unique outlook on the strength and direction of the price movement over specified periods of time frame. Technical indicators broadly serve three functions: to alert, to confirm, and to predict. Indicators show movement, and thus it becomes important to understand how the various technical indicators reflect prices in the market. The best way to learn about indicators is to first learn about the two different types of indicators: leading and lagging indicators. Leading indicators, also known as momentum oscillators, are designed to lead price movements. The benefit of leading indicators is that they generate early signals for entry and exit that provide opportunities to trade. These indicators help to identify oversold and overbought conditions during downtrending and uptrending markets, respectively. Some of the popular leading indicators include Commodity Channel Index (CCI), Relative Strength Index (RSI), Stochastic Oscillator, Momentum. Let's now look at the lagging indicator. Lagging indicators are used for trend determination and are the indicators that would follow a trend rather than predicting a reversal. These indicators work well when prices move in relatively long trends. They don't warn you of upcoming changes in prices, they simply tell you what prices are doing, i.e. rising or falling. These trend-following indicators usually make you buy and sell late. However, in exchange of missing the early opportunities, these indicators greatly reduce risk by keeping you on the right side of the market. Moving averages and the MACD are a couple of examples of trend-following or lagging indicators. Now we'll move to our trading platform, MetaTrader 4, in order to learn how one can use indicators for trading. Here is an example of using a moving average. One way to use it is simply by referring to the slope of the moving average that would dictate the trend. So an upslope here would indicate the uptrend, and the downslope means a downtrend. One should always keep the parameters of a moving average as per his or her need. If a trader is looking for short-term scenario, then 5-day, 10-day, or 20-day moving average can be helpful, which would give more emphasis on recent price movements, while in case of medium to longer term analysis, 50-day, 100-day and 200-day moving averages should be observed. It is better not to rely on a single moving average and use more than one moving averages. A crossover of short-term moving average to the long-term would indicate near-term strength, while a cross-under would signal near-term weakness as compared to long-term. For example, if a 20-day moving average is trading below a 50-day moving average, it indicates a short-term trend is downward as compared to a long-term trend. Now you know that the leading indicators are used to know entry and exit points, and the lagging indicators for trend determination. It should also be noted that one should use the mixture of leading and lagging indicators in order to get the precise view. For example, using moving averages with RSI or stochastic would help determine the trend in a better way. However, you should not try to overcomplicate the analysis by using two indicators which serve the same purpose, for example using MACD and RSI. We will now have an overview of the two basic chart patterns. As a trader, being able to recognize important chart patterns that occur frequently is important to improve the probability of a successful trade. Chart pattern is a part of technical analysis that can be used to make short-term or long-term forecasts. Chart patterns are nothing more than a combination of support and resistance lines with prices bouncing between them. There are two broad types of chart patterns, the continuation pattern and reversal pattern. Continuation chart patterns are so called since prices continue the overall long-term trend. The key feature of continuation patterns is the pre-existing long-term trend of the price. The theory of the continuation chart pattern suggests that the long-term trend is interrupted by patterns, and that the breakout from the pattern is likely to occur in the same direction as that of the initial trend. Some of the examples of continuation patterns are triangles, flags, pennants, rectangles, ascending and descending channels. The other pattern type is the reversal chart pattern. A reversal pattern signals that a prior trend is likely to reverse, and the prices are likely to break out in the opposite direction of the initial trend upon completion of the pattern. Again, the key element of reversal patterns is the evidence of a visible initial trend. Some of the important reversal patterns are double top, double bottom, head and shoulder and inverted head and shoulder, falling and rising wedges. You have now gained a basic understanding of the technical analysis. To make sure that this knowledge persists and develops, and gets developed, we strongly encourage you to try out day trading with the use of technical analysis on a demo account. For more information on demo account opening, please visit www.admiralmarkets.com.